does New York Insurance Law 3203, which requires insurance companies to refund premiums paid during the year the person died, apply to universal life policies? To find out, you have to read Nitkowitz versus Lincoln Life, but it's 11 pages. Don't have time for that? I've got you covered. This is TLDR, Too Long Didn't Read, where I cover New York Court of Appeals cases, and I try to do it in 5 minutes or less. This is the episode on the case of Nitkowitz versus Lincoln Life. This was published by the New York Court of Appeals on October 19th of 2023. The issue in this case is whether the discretionary payments that are made under a universal life insurance policy constitute premiums that must be refunded upon the death of the insured. I'll explain all that in a few moments. The background and context you have to understand to appreciate where this case fits in is that life insurance comes in a bunch of different flavors. There's whole life, there's term life, and then there's universal life, amongst many, many other varieties of life insurance policies. People are generally familiar with a regular whole or term life policy where you promise, you have a contract, an insurance agreement, where the policyholder agrees to make certain periodic required payments, let's say $12,000 a year, to get insurance coverage. And if the event occurs, if the death of the person occurs during that year, then the benefit, then the pot of money that's been promised on the back end gets paid out. So you pay $12,000, for example, and if you die that year, then your beneficiaries get $1 million. That would be a life insurance policy example under whole and term life. But there's also something called a universal life insurance policy. Under universal life, it's not a fixed periodic premium that's every year required or else you lose the coverage. Instead, a policyholder can make a payment at any time, at any amount, which is deposited in a cash value account. It's kind of like a part insurance policy, part investment vehicle, part tax shelter vehicle. It does a lot of different things. It's very flexible, a universal life insurance policy. And basically there's a premium amount that's made, that's elective, that person can pay every year. They should pay every year, but they don't have to pay it every year. That's not what's paying for the policy. The policy gets paid, deducted from the corpus of with the amount of money that's in the cash value account, the policy account, and that is what pays for the policy. So policy holders often choose to pay a planned premium, but the failure to pay that planned premium does not invalidate the policy. And in fact, some years you don't pay the planned premium, and the premium, the amount of the policy, the cost of the policy get deducted from what's in the policy itself. The other thing you have to understand is something called Insurance Law 3203. Insurance Law 3203, it says that all life insurance policies must contain certain provisions which are favorable to policyholders. In New York, the statute requires that insurance policies be favorable to policyholders. A2 of that section says that if the death of the insured occurs during a period for which the premium has been paid, then the insurer, the insurance company, should add to the policy proceeds a refund of the premiums actually paid beyond the death of the policyholder, the insured. What that means is, let's take that $12,000 example. Someone paid $12,000 for the year, but they died in February. So they paid $12,000 for a 12-month period, but they died after 2 months. There's $10,000 that, if you break that $12,000 into monthly amounts, $10,000 is the excess that they paid for that they didn't get the benefit of. So that should be refunded. That's what Insurance Law 3203 says. But what about on a universal life policy? That's the question that we have to address here. The facts are that Joan Loop Family Trust bought a universal life insurance policy under which Lincoln Life, which is the defendant here, agreed to provide universal life insurance coverage with Joan Loop Trust as the insured. There was a choice between the level and the death benefit, but basically they agreed to pay a planned premium every year, about $53,000, discretionary. They could pay more, they could pay less. But the benefit was going to be $1.5 million. $1.5 million to be paid upon the death of the insured, and the planned premium was $53,000. The trust paid the last premium in May of 2018, and in October, Lupe died. Joan Lupe died. The insurance company paid out the $1.5 million, but refused to pay back the $53,000 premium that was paid that year. The plaintiff filed a lawsuit saying, well, you owe me that under Insurance Law 3203, 1303. They move to dismiss. The insurance company moves to dismiss. The district court in Southern District grants the motion. It goes to the Second Circuit Court of Appeals, and they send it over to the Court of Appeals to determine whether that planned premium constitutes a premium under that section of law. Because if it does, then it has to be refunded. The holding by the New York Court of Appeals is that the statute, that insurance law 3203 applies to premiums that are actually paid, but premiums, that word premiums, means a periodic payment that is required to keep the insurance policy in effect. That sounds like a whole life or a term life premium. That's what we refer to when we say premium in whole life or term life policies. Here, the plaintiff paid premiums, but they were not for insurance. It was just an amount that was added to the policy value at a frequency of its own choosing. So that the policyholder could have paid $1 million instead of $53,000. It was just the premium that they paid. It was not a premium for insurance, and that's what the statute applies to. The premium does not, so the term premium that the holding is, the term premium under that insurance law does not include planned payments into a policy account, which are made at the policyholder's discretion. And that is the holding of Nitkowitz versus Lincoln Life. The insurance company does not have to return that unused portion because it wasn't obtained for insurance anyway. And that's the holding of Nitkowitz versus Lincoln Life. Have a good day. If you like what you just saw and want to see more just like it, please hit like or subscribe to let me know.